Hey gang, welcome to Time in the Market, the investing channel with a long-term focus, taking a look at WBD, Warner Brothers Discovery Inc. Stock is up about 3% after their Q1 earnings, and the earnings themselves were kind of mediocre. Two reasons why I think the stock is up. One, they announced an interesting product in that they're going to bundle their Max streaming service with Disney and their Disney Plus and Hulu service in a package that they hope reduces churn, that is attractive to consumers, etc. Really interesting that those two are working together, not only in that, but in their sports thing with Fox as well. It'll be interesting to see what comes of that. On top of that, the stock had a tough month in the lead up to earnings, down about 3.5%, even including the bump this morning. And a lot of that has to do with the fact that WBD is currently renegotiating their NBA rights, and everybody is paying through the roof for that. Amazon is in there with a big offer. ESPN is in there with a big offer, and NBC is in there for the third package at an offer that basically doubles what WBD is paying currently for the NBA for worst games. So it'll be interesting to see whether or not WBD pays a lot more to retain the NBA or just lets it go, and what either of those scenarios mean for WBD as a whole. Because if you look at their earnings and you look at the story here, the story is the same for a lot of these legacy media companies, is that legacy media is shrinking. And the question is whether or not these companies can grow their direct-to-consumer business fast enough in order to offset what's happening on the legacy studios, network side rather. And that's the reason a company like this is valued where it's valued, because WBD has generated $7.2 billion in free cash flow in the last 12 months and has a market cap of $19.5 billion. Now that looks really good on paper, but they also have $43 billion of gross debt, about $40 billion of net debt. That means that the enterprise value is closer to $63 billion or something of that nature. So maybe in relation to the enterprise value, that free cash flow isn't as attractive as you might think. And also, I think this free cash flow, the $7.2 billion, isn't something that they're going to repeat every single year. They just cut back on a lot of costs this year. And it'll be interesting to see what that means for their content in the next year or two and how they plan to grow their direct-to-consumer network with a content slate that's probably a bit more lacking than it used to be, especially as that slate becomes more competitive with other streaming services out there doing a lot of stuff as well. So if you look at their actual results, down 7% for Q1, not great. The market expected something closer to 4%. Again, net losses are there. EBITDA is down about 20%, and a lot of that is driven by the fact that last years they had Hogwarts Legacy, a very successful game in their gaming segment. This year they had Suicide Squad, Kill the Justice League, a very not successful game in their gaming segment, so they took a cut because of that, and that's kind of a problem. But because of all the net working capital stuff, because of all the cutbacks on their expenses, their free cash flow actually went from negative $585 million to positive $390 million. So big improvement year over year. And again, this is always a free cash flow play. This is always going to be how fast can they pay down that debt. They repaid $1.1 billion worth of debt during Q1. Again, $43 billion worth of gross debt, a 4.1x net leverage. Their goal is always going to be 2.5 to 3x net, so they still have another $10 to $15 billion of debt to pay down. But the nice thing about their debt is that it's not too bad. If you look at their debt, most of it is kind of a low rate. The average duration is about 15 years. The average yield is about 4.6%, and they just announced a $1.75 billion tender offer to buy back more debt. And I think they can buy back their debt, and they can buy back their debt at a value that's probably below par. Because if you think about this debt that they issued that has a 3 to 4% rate, especially the ones that are coming up, you can get a 4 to 5 to 6%, almost 6% rate on the risk-free bond market. If you go into the corporate bond market, you're talking 6 to 7%. So they're buying this stuff back at below par, which really benefits a company like WBD. They called it an asset on their call, which I kind of think it is. And that's probably a good thing. If you think that, the story here is going to be, yeah, the market cap sucks, but as you pay down that debt, the valuation will kind of transfer over into the market cap. The stock price should go up. That is probably true as long as they can keep generating free cash flow. And that's the big question here, because again, revenue down about 7%. That's a bit faster than people expected. Studios down about 12%. Again, a lot of that driven by the fact that they had a successful game last quarter, bad game this quarter. The movies themselves, Dune Part 2 and Godzilla, actually pretty solid results. But again, studios are suffering a bit because people aren't going to theaters as much as they otherwise would have in past years. Obviously, there's Barbie and Oppenheimer and movies like that are wildly successful, but in general, theaters are a bit muted versus pre-pandemic years. Then you look at the network segment, this is the big issue, down about 8%, down 11% advertising, 7% on distribution. And this is the problem. This is their cash cow. This is where they generate the majority of their EBITDA, the majority of their free cash flow. If this starts shrinking too fast, that means that free cash flow starts shrinking fast. That means they can't pay down the debt as much as they would have. And that may mean that the valuation the market is giving them may be relatively accurate. However, if they can kind of stem the bleeding here, grow the other part of their business in the direct-to-consumer part / studio side faster, then maybe the valuation is a bit heavy-handed. However, if you look at the direct-to-consumer business, quarter over quarter, flat growth, not great results. Advertising's up a bit because you've got the advertising supported service coming out now. So you kind of think about advertising being up about 70 million, but advertising here is down about 250 million. So maybe a third of that is being offset. However, you're not getting that much money in terms of distribution. And even though this is EBITDA positive, one thing to know if you're an investor, this includes HBO. So it's not just fully streaming. Like some people may say that, hey, Max is actually profitable. It's really not, because this includes the actual HBO channel that is in your TV station. It's kind of cheating the system. If they excluded that, Max would probably still be bleeding a bunch of money, as would Discovery Plus. Actually, I think Discovery Plus might have actually been profitable even before they merged. So Max would probably still be leading a bunch of stuff. On top of that, not growing revenue, not a good thing. Subs are up about 700,000 and domestically about 1.3 million internationally, so up quarter over quarter, up sequentially as well. But domestics are still about 2.5 million lower than they were Q1 2023. Not great. The nice thing to note is that they are launching in 26-ish European countries in the next couple of months, and a lot of that has to do with they have the rights to the Olympics, I believe, in Europe on a streaming basis. So it's going to be a good time to launch there. Hopefully that means they pick up quite a bit of international subs. But again, the ARPU, average revenue per user internationally, only 3.75 versus 11.72 domestically. On top of that, they talk about churn a lot. People subscribe for a month to watch the TV show they want to watch, and they delete the app. That's why they're bundling these services with Disney, partnering with Disney and other channels on these sports bundles or Disney, Hulu, Max bundles, because they think if somebody subscribes to all three, there's always going to be something to watch, and they can, get that 12-month revenue instead of getting that 1 month of revenue from the person that only subscribed to watch one TV show. And if it improves churn, that's a good thing for a business like Disney or WBD. On top of that, since they're avoiding kind of these third parties, like Roku's and Amazon's and Apple's, if you subscribe through those avenues, those companies take 30% of the pie. Whereas right now, they're kind of the distributor of their own stuff alongside with Disney, so they get more of the money that they would otherwise get. So overall, kind of a good idea, but still looking kind of mediocre. You need this business to grow because this business is going to shrink. So if this is down 8% and this is up nothing, that's a problem. And if this continues to be the case, quarter over quarter, year over year, that's going to be a problem. This business needs to offset the losses that are happening here in order for this to be a long-term success story. And I think we're a long ways away from that becoming reality. Now, the other aspect of this would be that networks start slowing down a little bit less than the 8% they're dropping now. If networks is down 1% quarter over quarter for the next couple of years, that's a good thing because it allows the direct-to-consumer stuff to grow as they expand into other markets, as they introduce new channels, introduce new bundles, etc. But if this is down 8% quarter over quarter over quarter, this needs to grow at like 10% plus in order for this to be a success, because studios is going to be all over the place any given month based on successes of games and TV shows and productions and movies, etc. This is going to shrink. This can't not grow. And if they launch in Europe in the next year, and some of their big shows like House of the Dragons come out, and they're not seeing a big shift in overall subscribers, if they're not seeing big growth over here, that's going to be a problem, and that's going to be reflected in the valuation that this company is getting. So as we look at the valuation, again, video is purely for informational, educational, entertainment purposes only. It is not investment advice. Please do your own due diligence. Here's the valuation thesis behind this. This is getting a 25% free cash flow yield based on the next 12 months projected free cash flow on a market cap basis. On an enterprise value basis, it's about 7.7%. If I pop a 16% free cash flow yield on the assumption that they're going to continue to pay down debt and get a 10% target return, kind of gets me to about where they're trading at today. Again, this kind of assumes a free cash flow yield that's sort of much better than what the market is giving them right now. Why would that be the case? Because the thesis is always going to be the same. This is a company that currently has an enterprise value of $63 billion with $43 billion worth of debt. In the next couple of years, they're going to generate, let's say, $25 billion worth of free cash flow, assuming some shrinkage in their revenue and maybe some improvement on the margin side as they cut back on costs and do whatever it is they're doing with the integration stuff. They're going to pay back, maybe $20 billion worth of debt. If you assume that the enterprise value doesn't change because the market continues to value it at a similar free cash flow yield, because free cash flow is going to stay around $5 billion for the next couple of years, assuming that happens, this should be a $39 billion market cap company as some of that debt valuation gets transferred into the market cap as the market reevaluates how they look at this, because now their debt to EBITDA is much lower, as the riskiness kind of wears off, as the market starts to see that DTC is offsetting some of the losses on the legacy stuff, as the legacy stuff maybe starts to slow down. Now this is a $39 billion market cap company, which is basically double what it is today. That's kind of the thesis. That's what you have to expect to happen if you want this to be a successful return from where it is today. And I think that's going to take a while to play out. And that's always been my thesis. That's why I bought this stock in the 730 range when it dropped. As I look at this today, would I buy more? After these earnings, I'm a bit worried because the network stuff is shrinking faster than many expected. You're looking at a negative 8% drop overall versus a negative 4% drop expected. That made me reassess what I'm seeing in the revenue growth for the next couple of years. I was kind of in that 2% for a while range. Now I'm in the negatives to zero range. Their margins are improving, which is nice to see. They're using the money to pay down debt. Now the question is DTC actually going to grow? Right now, the answer is no, it's not growing. It's flat year over year. That's a bad thing. But it's launching in Europe. They're doing this bundle thing. They have this sports bundle that may or may not come out. There's not really any news on it. They're continuing to pay down debt. They're doing okay. But I need to see that in order to buy more. So when it was at 730 a couple weeks ago, I bought some more. That was prior to earnings. Now, if I were to buy more, I'd probably need something in that range or lower. Like if you look at a 15% target return with these assumptions, and you can play with the spreadsheet as you want, file, make a copy, go ahead and go to town, you get a price of 630. Now, maybe that's a bit too low, but in order for me to be interested in building my position more than it is today, one, I'd have to see some glimmer of hope that DTC is actually going to start growing faster, because 0% growth on a business that should be growing is not good when everything else is shrinking. And or I'd have to get a better gauge that legacy is actually shrinking slower than people expect it to shrink. Because in the long term, this could be a really good play. They're going to pay down debt. They're going to get a lot of flexibility with their money if they continue to generate free cash flow into the latter part of the 20s, latter part of this decade. They can start utilizing that money to pay back shares. If you kind of think about the amount of free cash flow they're going to generate, potentially they're going to generate $25 billion worth of free cash flow in the next 5 years. That's more than the market cap of their entire company. In the last 12 months, they generated $7 billion worth of free cash flow. That's 36% of their market cap. That's 12% of their enterprise value, 11% of their enterprise value. This is an interesting business, but it's a business that is in secular decline that has to show that it can do something to combat that. And right now, at least within these earnings, it hasn't shown that. Now it's showing that it has some strategies to do that. These bundles, launching in Europe, eventually launching more in Asia, trying to grow in the United States, which is really going to be key. But it's also doing some dumb stuff. Like, yeah, we're generating a ton of free cash flow, but a lot of that comes at the expense of cutting back on content. And while they have some content, obviously, this is a marketplace in the streaming world where, there's 5 or 6 streaming services, all of which offer a ton of content. So it's very easy to just say, I'm just going to cancel Max for a while. And, every 2 months a good show comes out, and maybe after 4 months I'll subscribe for a month, watch all that stuff, and then go back to Netflix, because Netflix is producing a ton of content. A ton. And now Disney Plus is cutting back on content, which also seems like a bad idea. So maybe they're saying, hey, with Disney Plus, we're going to cut back on content along with Max. But in order to combat that, because we have a low amount of content, we're going to combine it all into one package. And that'll be good because that'll compete with the amount of content that Netflix is pumping out. On top of that, you've got stuff like Apple TV Plus doing a lot of stuff on the sci-fi space. A lot of good TV shows. Actually, Apple TV Plus is probably my favorite TV channel. And Amazon Prime is doing a ton of stuff with television, gobbling up all of the sports rights. I mean, what happens if the Warner Brothers division loses the NBA? What does that mean for the fees that they get for TNT? Do they drop down a lot? How much advertising do they lose? Obviously, they save $1 billion plus on the cost of the sports rights, but what are they going to do with that money? Is it just going to go towards debt? Can they do anything else with it? Are they going to produce more content to drive subscribers towards Max? What are they going to do? That's an unknown. This is a big question mark for me, but it is an interesting roll of the dice in that if they don't completely muck it up, if they can do something to kind of slow the decline in legacy, grow DTC, then 5 to 10 years from now, this could be a multi-bagger from where it's trading at today. However, if legacy shrinks too fast, if DTC doesn't grow enough, this could go the way of Paramount, where, it just sort of sucks and it gets bought out at a valuation that's lower than today. But I'm willing to take that roll of the die. This isn't a huge investment for me. It's not a huge amount of money. I think the long-term reward is sizable enough that I could take the downside. And the downside is obviously going to be there because this is a stock that has not done anything at all since it kind of split off and merged with Discovery. And I don't know when that changes, but it doesn't seem like it's going to change today based on the earnings that they just released. I need to see more before I'd be comfortable enough building out a bigger position. And if I wanted to build a bigger position, I'd want something in the 6s, I think. Let me know what you think. Do you agree? Do you disagree? Leave a comment down below, like, subscribe, all that good stuff. Thanks for watching. Have a good day. Bye.